This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
With our first session on pension schemes, we reminded ourselves about what we'd looked at and dealt with in Chapter 2, and also then in Chapter 9 on employment income, so far as the different pension schemes were concerned and the nature of the pension contributions made, how tax relief would be given in respect of those contributions. The two types of scheme that we should now be very familiar with: an occupational pension scheme, one that's run by an employer, and into which scheme an employer will always make a contribution. The employee may also make a contribution, and certainly in terms of any exam question you see, it is most probable will be making such a contribution. So how do we get tax relief on those contributions? Well, those made by the employer, usually a company there, those are tax-deductible expenses in deriving the trading profit of the business. They're the company. And we'll look at that in corporation tax in Chapter 16 and beyond. So far as those contributions were concerned, allowable deductions for the company within its corporate tax computation, and an exempt benefit so far as the individual is concerned. In Chapter 9, an exempt benefit, the contribution made by the employer. What about the contribution made by the employee? Well, that was an allowable deduction to be deducted in deriving the employment income to include within the income tax computation. So whereas the employer contribution did not touch the face of the income tax computation, other than for us in a Section C question to have noted that it was an exempt benefit and therefore did not get included within the employment income assessment, any contribution made by an employee will be an allowable deduction against the employment income assessment. But there are limits placed on how much of the contributions made by employee by employer, the total pension input, how much total pension input will be allowed in terms of achieving tax relief. And the limitation that we saw placed on that was the higher of two figures. One, a gross figure of £3,600 worth of contribution paid in a tax year, and the other, and it's usually this, as it's usually a much bigger figure than 3,600, the relevant earnings of the individual taxpayer. Those relevant earnings being, if you're an employee, your employment income assessment. Now, of course, not all employees benefit from membership of an occupational pension scheme. So they, like the self-employed, have only one option as regards using a pension scheme and contributing towards their pension fund. That's a personal pension scheme. So far as personal pension scheme contributions are concerned, there is no deduction that features within any employment income or trading income computation. It is not deducted in deriving the net income, the taxable income of the taxpayer. Instead, the way in which tax relief is given depends on the level of taxpayer that the taxpayer is. If you're just a basic rate taxpayer, we get basic rate tax relief at source. You want £10,000 of contribution to be benefited, to rather be credited to the benefit of your pension fund, then you made a net contribution of £8,000, and the 20% tax that you'd suffered on what would have been a gross figure of £10,000, 20% of £10,000 is £2,000, to bring you to a net of £8,000. That tax, that basic rate tax deducted at source, that would be paid over by HMRC, who've collected that tax, into your pension fund. You put in 8, your fund is credited with 10. But if, of course, you were a higher rate taxpayer, or we go further to become an additional rate taxpayer, then additional and firstly higher rate relief will be provided. Now that is provided on the face of the computation, not again in deriving taxable income, but in the form of an extension of your basic rate band, and then, if necessary, your higher rate band. So if we had a 10,000 gross contribution, as we saw in that first session together, that means that your basic rate taxable income, instead of finishing at a basic rate band limit of 37,500, would be extended by 10 to 47,500, and your higher rate band limit of 150 would be extended to 160,000, pushing more income, therefore, out of higher rate and back into basic rate, out of additional rate and back into higher rate, and therefore benefiting for the difference between those two rates. So far as those personal pension contributions were concerned, again, we have limits placed on them in the form of our relevant earnings. The relevant earnings now for the self-employed would be your trading income assessment. So if you're an employee, it is your employment income. If you're self-employed, it is your trading income assessment for the tax year. There's one further possibility, maybe, that you could see within an objective testing question, and that was if you had a particular type of property income, that being from furnished holiday lettings. That too would represent relevant earnings. So the main limitation placed on what tax relief will be given on in respect of pension contributions was your relevant earnings. But what we also saw, and we now pick up this particular session from, is that we have a further overriding limitation in any tax year on the amount of contributions made by the taxpayer during that tax year that will attract tax relief, whether we're talking in terms of occupational or whether we're talking in terms of personal pension schemes. So let's pick it up therefore from section 2 here in chapter 10. As we've said, although tax relief is available on pension contributions up to the amount of, there's our expression, relevant earnings, for a particular tax year, this annual allowance acts as an overall annual limit. This is a final limiting factor in terms of what contributions will attract relief, and is usually the issue that is most likely to be tested within an examination question. So we need to know. A specific question just aimed at pension contributions is likely to involve the use of the annual allowance. Where tax relief contributions are paid in excess of the annual allowance there, an individual can make any contributions they like in relation to contributions into a pension fund, but we then limit as to what level of those contributions will achieve tax relief. So where tax relief contributions are paid in excess of the annual allowance, and as we'll look at in a moment's time, not just using the annual allowance of the current tax year, but then also including any brought forward unused allowances. And we'll look at that in just a moment. Now then, where tax relief contributions paid are in excess of the annual allowance for the year, plus the relevant unused annual allowance figures brought forward from what you'll see in a moment will be the previous 3 years. If you exceed that, then there will be an annual allowance charge. And that's the last thing we pick up on here in terms of any computational exercise that might involve you in the examination room in section 3. And that charge, that AA charge, is subject to income tax at the person's marginal rates, whether they be basic, higher, most likely higher, if not additional rate taxpayer. And that charge would be using the non-savings income tax rates. Okay, so what is this annual allowance? The annual allowance determining the total pension input allowed for tax relief each year is limited to £40,000. Again, I think you'll know it by then, but that information will be provided yet again on your tax rates and allowances section of your exam paper. Now then, we've also said that not only do you get the annual allowance of the year, but any unused annual allowance brought forward from the previous 3 years. And that's where this point comes in. If the annual allowance for a year is not fully utilised, so our contributions are less than £40,000 there for the tax year, and the taxpayer was a member of a pension scheme in that year, if you're not a member of a pension scheme, you're obviously not making any contributions. You do not get a £40,000 unused annual allowance. You must be a member of a pension scheme. Then, if you haven't used your full £40,000, then you get the unused allowance to carry forward. It is then possible to carry forward any unused amount for 3 years. Pension contributions made in a tax year will firstly use the AA of that tax year, followed by the unused AA of the previous, as we've said, 3 tax years. And because there's more than one of them, in what order do we use up that unused AA? Used on a FIFO basis there. Used on a FIFO basis. So if we never make contributions in excess of £40,000, then each year the annual allowance is big enough. And so long as we have the relevant earnings to validate such a contribution, tax relief would be given in full in relation to those contributions. That tax relief, of course, provided whether we're talking about an occupational pension scheme or whether we're talking in terms of a personal pension scheme. Let's just see how that system works with a little example. Now, what I've got here for you, taxpayer has trading income, so I'll talk you through this while you note it down here for future reference. Has trading income in the 2019-20 tax year of £90,000. Trading income. So there we go, we've got relevant earnings of £90,000. We're also told that has no other sources of taxable income. The relevance of that we'll see just a little bit later. So we've got relevant earnings of £90,000. Taxpayer has made the following gross personal pension contributions. Remember, personal pension contributions are said to be paid net. So if you pay £8,000 net from a few minutes back, it's a £10,000 gross figure. How do you know whether the figure given within the question is net or gross? They will tell you. If they simply tell you the amount paid was £8,000 in pension contributions, that is taken as the amount paid, i.e. a net figure. If it is to be the gross figure, it will say made gross personal pension contributions of £10,000 or made pension contributions in the tax year of £10,000 in brackets next to that, gross. So it will be clear if it is the gross figure. If there is no reference to gross, it is purely the amount paid, and therefore that is the net figure. You must gross it up. How do I gross it up for the basic rate? Times 100 over 80. 8,000 times 100 over 80 became £10,000. It was simple. Right, had the following gross personal pension contributions paid into a personal pension scheme. So there we go. What I've done is to give you, we're looking at our current tax year, 2019-20, and we therefore have unused allowance potentially to bring forward from the previous 3 years. Now, we've got the gross pension contributions. Each year we have an annual allowance of £40,000, so it's very simple in terms of working the unused AA. In 16-17, that will be 16,000. In 17-18, 10,000. In 18-19, 24,000. So those are the figures that we want in terms of any unused annual allowance. What we will be doing then is to establish on what figure tax relief will be achievable for contributions made in 19-20. So let's assume to begin with, we'll play around with a couple of numbers here, but let's say that the contribution that was paid in 2019-20, to make this of course more interesting, for the first time went above 40,000. And let's say that that was a gross figure of £50,000. So in which case, how do we now establish what will achieve tax relief? What do we say we would do? Back to the notes. What we have here is, I'll just go back to it. The AA determining the total pension input allowed for tax year, the tax relief, each year is limited to £40,000. Again, that information provided as we have seen. If the AA for a year is not fully utilised, well now the AA is fully utilised. And pension contributions paid in a tax year will firstly use the AA of that tax year. So if we look at our £50,000 payment in 2019-20, that therefore will use, firstly, the AA. So we've got our £50,000 contribution. So firstly, we would use the AA of 1920. That would equal £40,000, but we've paid £50,000 there. We've paid £50,000. So we now need another £10,000. Where do we go? Back to your note. Followed by unused AA of the previous 3 tax years, used on a first in, first out basis. So on a FIFO basis, we go back 3 years from 1920, 1, 2, 3 years, back to 1617. We have unused AA of £16,000. Is that enough to bring us up to our gross contribution paid for the year of £50,000? Yes, it is. Therefore, we'll now use the unused AA brought forward from 1617. How much of that do we need? £10,000. So the full £50,000 contribution will be allowable. Now, what they might also ask you to do in a question is to establish how much unused AA would then be carried forward from 2019-20 tax year. So what would happen? What we have done is to use all of our AA limit in 1920. We've used some, but not all, of 1617. But you can only carry forward for 3 years. 1617, 1 year to 1718, 2 years to 1819, 3 years to 1920. So the still remaining unused AA from 1617 will now be lost. We had unused AA of 16,000, and we used 10,000 of that unused AA brought forward into 1920 in the 1920 tax year. The £6,000 unused, too bad. That now has gone. So what do we have to carry forward? There's obviously nothing from 1920 because we paid more than 40,000. We used all of the 1920 AA. But we do have 2 figures, one from 1718, there's the unused AA of 10, and 1819, there's the unused annual allowance of 24,000. So we will be able to carry forward, therefore, some £34,000 of unused AA. That would go forward to the 2021 tax year. If you contributions again exceeded £40,000 in 2021 tax year, then you would start to use up unused AA from 3 years prior to that. That, therefore, would bring you back to 1718, up to a maximum of 10,000. So if you've gone over £50,000 in 2021, 40,000 for 2021 limit, 10,000 for the 1718 unused AA brought forward, and then you'd start to use up the unused AA from 1819. So whatever contribution has been made there, we'd be able to establish whether or not all of that contribution was to achieve tax relief. Now, at this point, we'll assume that the amount of contributions paid are within these overall limits for any tax year, the annual allowance limit for the year, at the moment a figure we know to be 40,000, plus unused AA brought forward from the previous 3 years. What we'll see later, of course, is maybe the amount of contributions that we made in the tax year have exceeded that combination of AA limit of the year plus the unused AA brought forward. And on that basis, therefore, we may end up with an AA charge. But that comes just a wee bit later in our studies. Okay. Let's go back to our notes now and see, well, we've skipped a few bits in between here. Because what we've seen is that the basic annual allowance figure is £40,000, a figure, as we've said, provided to you in your rates and allowances tables. However, there are limitations placed on that annual allowance depending on the income of the taxpayer. So let's see what we've got to say here about that. The normal annual allowance of 40,000, however, is tapered, i.e. reduced by. The reduction is £1 for every £2 by which a person's adjusted income exceeds £150,000. But it doesn't take that figure down from 40,000 to zero. It goes down to a minimum tapered annual allowance of £10,000. Now, you might recall back in Chapter 2, we saw an exercise that looked like this, where there was a reduction of £1 for every £2 worth of adjusted net income of the taxpayer. That was where we were establishing the limit and the restriction applied to personal allowances. This is a different exercise. This is a different exercise. Please do not confuse the two. So, the normal annual allowance of 40,000 tapered down to a minimum of £10,000. The tapering only applies if adjusted income exceeds £150,000. So some basic exercises here. So if a person had adjusted income of £180,000, then their AA will be reduced by 15,000. 180 exceeds 150 by 30,000. 30,000 divided by 2, that will be £15,000. So we'll take that away from the 40,000 and it will reduce it to a tapered AA of £25,000. As we've said, you do not taper down below £10,000. So a person with, if only, £210,000 or more of adjusted income will only be entitled to an annual allowance of £10,000. How do we get that? 210 minus 150, that would be 60,000. Divide by 2, that therefore would be 60 by 2, 30,000. Take 30,000 from your basic AA limit of 40, and there's your 10,000. So any adjusted income figure in excess of 210, then you don't need to do a calculation. The minimum AA allowed will be £10,000. What do we mean by adjusted income? It's obviously net income, which we're aware of at least I hope we're aware of, off the income tax computation. If you can't recall that, go back to the pro forma in Chapter 2 there. Net income plus any employee contributions to an occupational pension scheme, which of course will already have been deducted in calculating net income. Employee contributions into an occupational scheme have served to reduce the figure of employment income included within the income tax computation. We now we add that back. Plus, we also add in here, in deriving this adjusted income figure, any employer contributions to either occupational or into personal pension schemes. Any employer contributions are also added in. If you are self-employed, therefore, then there is no occupational scheme to pay into, neither by an employee nor by an employer. So for the self-employed, adjusted income is very much easier. It is simply the net income figure. There is no adjustment to do to it. It is the net income figure. Okay, so when we were looking at our limits, in terms of when we looked at these contributions here paid, we were basing any unused AA on a figure of £40,000 as an annual limit. If you look back to what I said here, taxpayer had trading income in 1920 of 90,000. Now, trading income, that was your relevant earnings, and no other sources of taxable income. What that is now telling you, you didn't know it as we read it for the first time, is that not only do you have relevant earnings of 90,000 upon which then to base the amount of contribution that will achieve tax relief. But we also know that 90,000 is the adjusted net income. This is your trading income here, no other sources of income. For the self-employed, adjusted net income is net income. That therefore is £90,000. What you may, of course, have to do is to deal with a situation where before you start to work out any unused annual allowance for the tax year, you've got to not just look at what gross contributions were paid in the tax year, whether 24, 30 or 16, or indeed £50,000. You've got to know what was the annual allowance for that particular year. And if your adjusted net income has gone above 150,000, it's going to be less than 40,000. That you must do first of all. Okay, returning to our notes now. We have a little example here. And what do we have to do? Compute the total pension input allowed for Aston for the 1920 tax year. So rather than being given an amount of contribution that's paid and determining will we get tax relief and how will we get tax relief in relation to that contribution for the tax year, what we're now asked to do is to work out for our hero here, Aston, what amount of total pension input would be allowed for the 1920 tax year, allowing the individual, if they have the cash available to make the contributions there, to be able to go up to the full maximum limit for that year. So what have we got here? Aston made the following gross amount of contributions into his pension scheme in earlier tax years. And we've got 16, 17, 62,000. Do we have any unused annual allowance, therefore, from that year? No, we do not. 30,000. Yeah, we've got unused annual allowance there, assuming, of course, that we're using a £40,000 AA figure. As would also be the case with £25,000 contribution, can we use those contributions? Can we use a 40,000 limit? Answer, Aston has an annual salary of £120,000. The adjusted income, therefore, based on that information, no other information about any other income of the taxpayer, the adjusted income is 120,000. It does not exceed 150,000. The amount of relevant earnings are also 120, and every one of those contributions is within that figure. So back in 1617, we'd have had 40,000 annual limit all used up. In 1718, we used 30 out of 40, and in 1819, we used 25 out of 40. Therefore, for the 1920 tax year, remember the order? Use firstly the AA annual allowance for that tax year, 1920. That will be £40,000. And then use the unused annual allowance brought forward for the previous 3 years. Well, there won't be any from 1617, so we use on a FIFO basis. So that would be firstly any 1718 and secondly any 1819 figure. Right, it shouldn't take you more than a minute just to work that through. When you've done that, come back to me. I'll take you through the answer, because the answer doesn't just include an answer to that question. It also then goes on to say, but what about if we have this information or that information? And I'll need to talk you through that. So just calculate that total pension input allowed for the 1920 tax year and then come back to me and we'll finish off this particular session. Okay, well, hopefully no problems in establishing the maximum gross contribution in terms of total pension input that would be allowed for our taxpayer here for the 1920 tax year. What's that total pension input made up of? In terms of an annual allowance here, we use firstly that of 1920, our current tax year. Note, Aston has adjusted income of £120,000 in 1920. That does not exceed £150,000. and therefore no tapering of the AA applies. So the full £40,000 would be available for relief. We then start to use up unused AA brought forward from the previous 3 years. And that means we go back on a FIFO basis, so back from 1920, would take us back 30 to 1617. But as we saw, the amount of contributions made in that tax year exceeded the 40,000 annual allowance, so all of that annual allowance would have been fully used back in 1617. So there's nothing brought forward. So far as 1718 and then 1819 are concerned, we've got our limits of 40. What do we actually contribute as a gross figure in those years? 30 and 25 respectively, giving us therefore 10,000 and 15,000 unused AA brought forward at the beginning of the 1920 year to add to the 40,000 AA of that year and give us a maximum gross contribution of £65,000. So that's the maximum that could be contributed, and for then full tax relief to be given in relation to that contribution. As we say here, it can be seen from the overworking that the current year's AA is used first, and then we use the AA brought forward, and that is used on a first in, first out basis. Right, well now play with those numbers. We worked out what the total pension input could be to achieve tax relief. Let's see what happens now with a given figure of contribution. So, if in 1920 Aston actually made a gross contribution of £45,000, that would be less than his relevant earnings of the year, which we know to be £120,000. So that amount would be allowable and would therefore qualify for relief and would utilise all of the 1920 annual allowance. So back to what we had, we would use firstly that 40,000. So there's none of that now left. We're making a gross contribution of 45,000. Nothing unused brought forward from 1617. Sticking with the FIFO basis, we then move to 1718, and we now use £5,000 of that to validate our gross contribution of 45,000 paid in the 1920 tax year. It would also mean that we have got £5,000 still to carry forward. Along with here, we haven't touched the 1819 figure. That would still be 15,000 to carry forward at the end of the year. Right. Just going back to these notes, I'll just clear that up so you can see it. Would utilise all of the 1920 AA of 40,000, 5,000 of the 10,000 unused AA brought forward from 1718. The remaining 5,000 would be carried forward for one more year. We've agreed that that 5,000 there is carried forward, but only be carried forward for one more year. You can carry forward for 3 years there. So as we move into 2021, that's going to be the last year on a count back from 2021, 1920, 1819, 1718. That's the last time we'll be able to use any unused AA brought forward for 1718. So let's see what might happen. As we said, the remaining 5,000 would be carried forward for one more year to 2021. So if a £30,000 gross contribution was then actually made within the 2021 tax year, then that would be within the annual allowance for 2021. So we would use 30 of the 40,000 annual allowance for the 2021 tax year. That means that there will be no usage of any brought forward unused annual allowance. So all of the 30,000 gross contribution would be an allowable an amount. Tax relief would be gained on all of that £30,000. But what now would be the unused allowance carried forward at the end of the 2021 tax year? The £5,000 that related to 1718, that now will be lost. That goes. So the £5,000 of unused AA from 17 would now lapse. So as in 21-22, after that year's own AA is used, there would be unused AA brought forward for use as follows. 3 years back from 21-22 would take us to 18-19. What do we have there? We haven't touched it. We've still got that £15,000. There's the 15,000. 1920, there is no unused AA. That's where we used all of the AA of 1920 in the first part of our calculations in this example. So nothing there. In 2021, the year that we've just seen, then we've only used 30 out of the 40. So we've got £10,000 of unused AA. So carried forward, therefore, out of our 2021 tax year into 21-22, we could use up the 21-22 AA limit itself of 40,000, then 15,000 of unused AA from 18-19, followed if necessary by £10,000 from 2021. A grand total pension input allowed again of £65,000. Okay, so that should allow us, therefore, to be able to establish, given any amount of relevant earnings, any amounts of contributions that have actually been paid, to establish within any tax year what the total pension input would be and what would be the make-up of that if we were not to fully utilise it. But at this point in time, we've stayed within the overall allowance for the year plus the unused AA brought forward from the previous 3 years. What we haven't therefore faced at the moment, until now, as you can see on the screen in front of you, is the prospect of an annual allowance charge. So what happened? As we stated above, tax relief is given on pension contributions up to the level of relevant earnings. You must have relevant earnings to be able to make contributions here of the taxpayer for a tax year. And if the tax relief contributions exceed the AA, including, as we've been talking about, any unused allowances brought forward from the previous 3 years, if we go above that total pension input capacity, there will be an AA charge, chargeable to income tax at the taxpayer's marginal rates. This is a figure of tax charge that will be part of your income tax liability calculation. Let's see how that works with illustration 2, whereby Villa has a trading profit in the 1920 tax year of £250,000. Big number, £250,000. Now, we have been looking at relevant earnings and adjusted income figures that have not previously exceeded £150,000. Remember what we said. If we have an adjusted income figure, as previously defined, in excess of £150,000, then you would start to taper, to limit the annual allowance of £40,000. What was the basis of the limitation? You restrict by £1 for every £2 of such adjusted income in excess of the limit of £150,000. And what that meant was, when you got to 210,000 of adjusted income and above, you would taper no further, because that 210 minus 150 equals 60,000. Divide by 2 is a £30,000 reduction, a tapered reduction there. It leaves you with 10,000, and that's the minimum allowed. So whether it's 210 or, as here, 250, what we now know is the AA for the 1920 tax year will only be £10,000. So if we go above 10,000 in terms of our gross contributions, which we most certainly will here, then that means that we're going to have to then use up unused AA brought forward from the previous 3 years. And if we use all of that up and go further, then we face an AA charge. So let's see what we've got. Made a contribution into a personal pension scheme during the year of £70,000 gross. So again, they could have told you here that the personal pension gross figure as stated was 70,000, or could simply have said had actually paid 80% of 70, i.e. £56,000 into the pension fund. If they just said paid 56, that would be the net figure. 56 times 100 over 80, grossing up for the 20% basic rate of income tax, would of course bring you back to 70,000 gross. So make sure you're dealing with the correct gross figure before you go any further. Villa joined the pension scheme in 1819, in which year he made gross personal pension contributions of 10,000 and had net income of 90,000. Only joined the pension scheme in 1819, so there's no unused annual allowance brought forward from any prior year. You have to be in a pension scheme to benefit from unused allowance being carried forward from that year. What have we got to do? Compute the annual allowance charge, there will be one, that will arise in 1920, and prepare an income tax computation for Villa, showing his income tax liability for that tax year. So what have we got? As we know, for 1920, Villa has relevant earnings of £250,000. So our gross contribution of £70,000 is well within the figure of relevant earnings. But of course, although it's within the figure of relevant earnings and will, to begin with, attract tax relief as a result of being within the figure of relevant earnings, if we go above our annual allowance limit, plus any brought forward annual allowance unused from the previous 3 years, then we're going to face a clawback in relation to some of that tax relief in the form of an annual allowance charge, the object of this exercise. So relevant earnings of 250, gross contribution of 70,000 will attract tax relief, but his AA for 1920 will be reduced to £10,000. Yes, our adjusted income exceeds 210,000, so the maximum AA is £10,000. As we've said, as the adjusted income exceeds 210. Villa was not a member of a pension scheme until 1819, so will have no unused AA brought forward from earlier years. It starts with 1819. We will have unused AA brought forward from 1819 of 30,000. Why? His AA limit was the full 40,000. We had what was his figure there for the year? We had net income of £90,000 back in 1819. So no problem in terms of getting the full £40,000 AA. AA limit was the full 40,000, of which he's used only £10,000. It will therefore have an AA charge of 30,000, being 70 minus 30 plus 10. Let's just see how we went very quickly to that calculation of what the AA charge would be based on, what the AA charge would be. Obviously, we've got to define the tax calculation on that as well within the income tax computation. What we see is that for the current year, 1920, we're going to have 10,000 as our AA limit. We then have brought forward from just 1 year, the 1819 tax year, £30,000 of unused AA. That therefore in total is 40,000 as our maximum total pension input allowed for the year. But we've made a gross contribution of 70. 70 minus 40, therefore, there's your £30,000. In terms of our income tax computation, we've got trading income of £250,000. That is net income of 250. Now you're looking at that figure and thinking immediately, well, there won't be any personal allowance. Go back to, if you've forgotten it, about chapter 2 there, and how we check on our adjusted net income figure of 100,000 and then 125,000 pounds in terms of fully abating the personal allowance. But it is adjusted net income. So how do we know the personal allowance here? It very obviously is nil, but how do we confirm that? Note 1. Villa's adjusted net income for purposes of computing his personal allowance is 180. £250,000 minus the gross personal pension contributions. Now again, please be careful. We've just been talking about adjusted income in relation to the pension contributions and defining the AA limit of the year based on an adjusted income figure. If we go above 150, then we will start to taper down to a minimum, as we've seen in this year, £10,000. This is chapter 2, the restriction of the personal allowance. Again, if you can't remember this, you go back now to chapter 2 and you remind yourself of this. You've got to differentiate between this chapter 2 exercise. How do we compute our revised, if any, personal allowance with what we've just been doing on adjusted income in terms of computing the amount of AA limit for the year? What starts as a maximum 40 and ends up as a minimum £10,000 if we have adjusted income in excess of 150,000 and then in excess of 210. Right, so here therefore, adjusted net income for purposes of personal allowance, 250 is the net minus the gross personal pension contribution. Again, remember, we would deduct gift aid payments in their gross form and personal pension contributions would be deducted, again, back in chapter 2. That therefore gives us 180,000. That exceeds £125,000, so the personal allowance is reduced to 0. So what we've got is taxable income of £250,000. Now, before we start to tax that taxable income, what we need to know is what is going to be the revised basic rate and higher rate band limits. What we have here, going back to the information we were told, this was a contribution into a personal pension scheme, a gross figure of £70,000. It is a personal pension scheme that we are talking in terms of. And we know that any contributions into a personal pension scheme do not impact on the taxpayer's calculation of net income or taxable income. Don't calculate a part of your taxable income on the face of the income tax computation. Instead, what do? We extend both the basic rate band and, as will be applicable here, the higher rate band by the gross amount of those personal pension contributions. So before here we start to compute how much basic, higher rate and additional rate tax we may have, we need to establish what the revised figures of basic rate band and higher rate band will be. As Villa has contributed to a personal pension scheme, not an occupational scheme, basic and higher rate band limits increased by the gross contribution of 70. So the basic rate band limit of 37.5 is now 107.5. The higher rate band limit 150 plus 70 is now 220. Those are the figures we use. There's also the comment here that I made reference to earlier, is that they could have given you the same information within this question simply by saying that you actually paid 56,000. That would have worked to a gross of £70,000. So always remember, pick up the correct gross figure before doing any of these calculations. Right, so we've got taxable income of 250. So we've gone above both the revised basic and revised higher rate band limit. The basic rate band limit £107,500 at 20%. All of this, as we can see, is non-savings income, so it's 20%. Higher rate. Now, the difference between the basic rate band limit and the higher rate band limit remains the same. We've added £70,000 to each of those figures. And that means, therefore, that we'll have the same £112,500 gap between the revised basic rate band limit of £107,500 and the revised higher rate band limit of, as we said, if you just look back up there, £220,000. So that will be £112,500 at 40%, and just tick off those figures, make sure we've got the right numbers. We've got taxable income of £250. At the moment, we've gone to £220 at that point, leaving £30,000, 45%, get your additional rate. And now we get this addition in. This is where this AA, our annual allowance charge, comes in. Because we've exceeded the annual allowance limit for the year, we've got an AA charge of £30,000. So the tax relief we had originally been given in terms of this contribution is now effectively being withdrawn in terms of this AA charge. Now, you've got to be careful in terms of an exam question about what it, of course, on an objective testing question is asking you to do. Are we computing what the overall income tax liability will be, inclusive of the AA charge, or do they simply ask you to compute the AA charge itself? There's some £13,500. So again, so very important, as it always is, to make sure that before you start clicking buttons on your calculator, writing numbers down, doing calculations, are you working with the right numbers? Are you actually satisfying the precise requirement, or have you just assumed it was like another question you'd seen before? Do not do that. Make sure you answer the question that was posed. Again, the AA charge is at 45%. Your marginal rate of tax, you are already an additional rate taxpayer. So the bit that we now add on top of your normal taxable income is in the additional rate. Non-savings income, tax therefore at 45%. Okay, based on that, you would then be able to, again, as it's so often the case referenced here at the end of these chapters, you go to the Finance Act 2019 technical article written by our exam team, and you'll find a number of examples in there to further practice. Again, some 5 examples, 20 through to 24 there. Plenty of practice for you to have a go at. Make sure you work those before you go any further. What you can then also do, or you can do this one first if you like, attempt practice question 20 at the back of these notes there. There's just one final little bit. This again, it could only be tested in written form, and therefore I don't think it'll be tested at all, in all honesty. But we've seen one limit that is the really important one that you need to know about, which year on year, as you make contributions into your pension fund there, we're governed by not just relevant earnings that you have for the tax year, but by the relevant AA limit for that year. But what there is also going to be is an overall lifetime limit on the amount of pension fund that you can build up, and then still take that pension in the most tax efficient way. So when the taxpayer takes their pension, a tax-free lump sum of 25% of the pension fund may be taken, and whereas previously the remainder would have been used to buy a pension annuity, the taxpayer may now withdraw the balance of the pension fund as taxable income whenever they wish. There's again additional information. You can do a drawdown in relation to that. But in addition to the AA limiting the tax relief available on yearly contributions, we have a lifetime allowance of £1,055,000 that applies to the value of the pension fund built up at the date the taxpayer takes their pension. If the fund value exceeds this limit, an income tax charge will arise on the excess, depending on how the excess is used. None of which do we need to know about because those calculations are not within the syllabus. We simply have to be aware that if we go above that lifetime allowance of £1,055,000, then additional tax charges will be made when you take your pension. What they are depends on how you take the pension, the tax-free lump sum or an annuity or a drawdown, none of which you need to be familiar with, and those calculations are outside the scope of your syllabus. So it's all about use of the relevant AA limit in relation to the contributions made, and then simply reading the question carefully. What is it are they asking you to compute? Are they asking you to compute the total pension input allowed for the year? Are they asking you to compute the income tax liability of the taxpayer for the tax year? Once all of that computation is complete, are they asking you to compute the AA charge for the year? Are they asking you to calculate the tax on the AA charge for the year? Read the question carefully. Right, practice with those examples. That then means that all of the relevant content of the income tax computation, or what could be covered within an income tax exercise, has been dealt with. In our next session together, we move away from income tax to look at another tax that is relevant to, as we've been talking about here, employment income and trading income, and that's national insurance contributions. Thankfully, that's a relatively short chapter with some very simple calculations to perform, and it should be an easy Section A objective testing question, or otherwise maybe a mark 2 or 4 marks within potentially a Section C question. Nice to get the big one of income tax now out of the way. We'll then, as we said, move to national insurance contributions, and after that look at the next main personal tax that is within the syllabus. From Chapter 12 onwards, we deal with CGT.